Hey, did we start this thing early? Ladies and gentlemen, this is Gandalf, the Imperior. Today I want to show you a very, very intelligent person, a wonderful presenter. He's insightful. He's very funny. He always has good timing. But he is not here today. No, ladies and gentlemen, Brandon Ketchrin has much better things to do on a Saturday than to talk about tax law. Today, you're stuck with Gassman again. He's disorganized, he's not very polite, and you can't believe everything he says. Nevertheless, this presentation will qualify for 1 hour of misery. And CPA from Florida continuing, hey, stop it. I'm getting dizzy. Stop that. Stop that. Stop it. Okay, ready or not? And against the wishes of many, here is today's presentation. Okay. Hello, this is Alan Gassman, and I'm here today to talk to you about spousal limited access trusts, installment sales, private annuities, self-canceling installment notes, and beer. Now, it's still morning here in Florida, so I can't publicly drink a beer, but I could drink a decaf coffee with cream. We are on the GoToMeeting platform here. So what you can do is, if you have a question, go to the Upside Down Pyramid, sing the song King Tut by Steve Martin, and then type in your question, type. The first question's already out. Will the slides be posted soon? Brittany, will the slides be posted soon? Brittany says the slides will be posted soon. By the way, if you're watching a rerun of this, first of all, don't you have anything better to watch? Secondly, watch, see, watch. And then thirdly, you can adjust your settings when you're on YouTube to get a higher definition. So that can be helpful. So you can see our cursor and our curses as well. Something very exciting for those of us who are tax nerds is that the US Supreme Court overruled the 1984 Supreme Court decision of Chevron. That decision said that when you read an IRS or other government agency regulation, it's probably right. And now it's not probably right anymore. It's going to be judged at a tougher standard on the IRS. Now there's thousands of regulation sections or subsections, and many taxpayers are going to be impacted by this, where the law may not be what it's been since 1984. So it'll be extremely interesting. And Monday by 3:30 p.m., I'm going to know something about it. And Peter Farrell, our newest tax lawyer at our law firm, is going to know even more about it. He's studying it right now. So if you have any questions or any comments on this new Chevron case, let us know. It is the equivalent of a Roe versus Wade event in some legal and tax communities. And I think it's going to hit the qualified easement area. I think it's going to hit some charitable trust planning that I believe will be enhanced, and we'll hopefully tell you more Monday at 3:30. It'll be 30 minutes, but it will seem longer. And if you're watching a replay of this, you'll be able to find this on our YouTube website. If you just Google Gassman, Gassman, YouTube, and Chevron, Chevron, you will probably find it. Okay, so I just want to plug the 50th Notre Dame Tax and Estate Planning Institute. Last year, I had some clients buy the audio tapes, and they really enjoyed them. But I'm going to point out that my partner, Brandon Ketron, who's much smaller and also taller than me, will be speaking Wednesday at 1:45 on financial modeling with Brad Dillon. I think they have a runway they're going to walk down on and stuff like that, different types of tax outfits and things like that. And then Thursday at 2 o'clock, I'm going to talk on creative uses of charitable remainder trusts. Now, the rest of the time, you can just hang out in South Bend and watch Notre Dame, look around Notre Dame, and then go to the football game on Saturday. But what I really like about the Notre Dame Institute is that Jerry Hash forces all of the presenters to really cover the area. He gives us a full 60 minutes, and then he also, as you can see here, gives the attendees 2 tracks. So I'll be going at the same time that Beth Knight is talking on the exercise of trustee discretion. So that way people who have no interest in charitable trusts but are more interested in trustee discretion will have the discretion to go see Beth. And that's during the day, not the night. Okay, I'm also going to talk about EstateView software later on, but by popular demand, I won't be talking about it until towards the end of this program, but we're going to make a special offer today because we're desperate for cash. Anyway, what is a spousal limited access trust? This is an irrevocable trust. It has nothing to do with your ear, but if you're auditory, it might help you to know that it's an irrevocable trust that I, as the grantor or the settlor, can establish and fund for the benefit of Marcia, my spouse, and our descendants. And once I put the assets in the SLAT, they are out of my estate for federal estate tax purposes, and the growth within that trust will be out of my estate for estate tax purposes. And perhaps equally as important for many clients, my creditors will not be able to touch that trust if I am not a beneficiary of it, or if an asset protection jurisdiction law applies, even though I can indirectly benefit from that trust because my beloved spouse, who helps pay the expenses in our household, can live on it entirely for her reasonable health, education, maintenance, and support. So those of you who know Marcia know that that's could be a high number. Nevertheless, she can be the trustee of the trust, and her creditors can't touch it because she did not fund it. I fund it with my assets, which was a lot of fun, and she controls it. But in the law of all 50 states that I'm aware of, her creditors can't reach into it, even though she's the trustee and can live off of it. She can also direct where it goes on her death. So that's a pretty neat thing. And then ask me, how is that taxed? Who pays the income tax on that trust? And the answer is, if the spouse is the trustee, or if there's the proper magic language, yes, magic language, magic, then the trust is disregarded for income tax purposes, and I pay the income tax on the capital gains, the interest, the dividends. I get the losses and the depreciation. Whatever happens in that trust is on my Form 1040 income tax return, which is a great thing for 2 reasons. Number 1, it doesn't need a separate tax return. Number 2, my payment of the tax is an indirect gift to that trust, but is not considered a gift for estate and gift tax purposes. And we call that the burn. Professor Hesh, I think, coined the term the burn because it burns off my fatty estate, and or I had too much wood in my estate, one of those, therefore reducing my federal estate tax. And we find that SLATs, sometimes 1/3 or more of the tax savings is from the burn, which we'll talk more about. So terminology, you have the grantor spouse who establishes the trust, and then the beneficiary spouse. And then speaking of the word terminology, what happens if the marriage terminates? Well, if the marriage terminates by reason of divorce, it depends on what the trust says. We typically have two different kinds of SLATs from a marital standpoint. If the SLAT is being funded with assets that my client has from a prior marriage, or that are protected under a prenuptial agreement, or they're separate property of my client, then we put in the SLAT that if there's a divorce during the marriage, the beneficiary spouse who did not contribute to the SLAT is out as a beneficiary. And in the event of a remarriage, the new spouse is in. On the other hand, if these are marital assets, or in the event of a divorce before the SLAT, they would have been divided equally, then our SLAT normally says in the unlikely event of divorce. By the way, even if divorce is likely, always put in your documents in the highly unlikely event of divorce. That might help the marriage be extended a few days. In that event, the SLAT turns into two trusts. Marcia takes half of the assets as trustee of the continuing SLAT, and I am out of it with no further authority or control. The other half of the SLAT, I have the power to replace the trustee, and the trustee has the power to give nothing to my spouse. And in the event of a remarriage, that half SLAT could benefit my next spouse, which is called the floating spouse provision. Now, when you go to the beneficiary spouse before you sign the SLAT and say, by the way, there's a floating spouse provision, what's that? That means that if you and your spouse get divorced, the next spouse is in there. Get that out of there. Well, it could be important, like if you died and your spouse needed assets, then your spouse, if he or she remarries, might have a lovely new spouse who could receive benefits from the SLAT and then share those benefits by paying half of the household expenses. And then the spouse says, oh, I think I understand. Get that clause out of there. I don't want anyone's new spouse in my trust. Well, who said it was your trust? Okay, you can imagine how the conversation goes. But that is the spousal limited access trust. Now, there are a lot of US taxpayers who have net worths, let's say between 10 and 15 million. And on January 1st, 2026, there's a possibility that the estate tax exclusion per person will go from 7 million to 14 million in approximate numbers. That's what the law says today, although I think it's most likely that a president and Congress will put the law back to where it is so it doesn't go down by half in 2026. But anyway, let's say that Marcia and I each have 7.5 million in assets. I want to use more than 7.5 million of my estate tax exemption before 2026. In fact, in late 2025, on December 30, 2025 at 4 o'clock, I'm going to call my estate planning lawyer's office and say, I heard there's a deadline tomorrow. Can I come in and do a new SLAT? And can I go ahead and have Marcia give me $5 million and I'll take my 7 and we'll put 12 in the new SLAT to eliminate estate tax for our family? Could I come by around 9 in the morning to get that done? And of course, the lawyer I call is going to say no, because of the step transaction doctrine and because you should have planned ahead. What's that saying? Failure to plan ahead on your part doesn't constitute an emergency on my part, right? So, and the hair was parted. Moses parted his hair, I think. But anyway, the step transaction doctrine says if Marcia gives me assets and then I put the assets in a trust for her, that it's like she put the assets in the trust for her, and then the estate tax planning doesn't work. So if you're going to be doing this, you might want to think about whether it's already too late. Probably the best thing is I give Marcia a promissory note for $7 million. She gives me $7 million worth of assets, and then I owe her $7 million, which will not be easy to repay. But if I have the financial wherewithal to repay it, that may avoid the step transaction doctrine. Now, something very, very powerful in the estate tax arena, and it's not deodorant, it's even more powerful and important than deodorant, is the ability to loan money or to sell assets and take back a note at below market rates. Now, you can see here in June of 2023, and you may feel like you've been sitting here since June of 2023, but we're only 14 minutes into the presentation. The applicable federal rate for a 9-year or longer note between family members was 3.75%. A year before that, it was at or under 2%. Now it is at 4.56%. But if my investment portfolio averages 7% a year, which is what most conservative investment portfolios tend to average, do you like that physical effect there? Science fiction. Then 7% rate of return minus a 4.56% interest rate is a 2.5% difference. So if I could loan a trust for my lovely grandchildren $10 million, and they can make 200 and some odd thousand a year on the spread between a 7% rate of return and a 4.56% interest rate, that's helpful. Of course, what's even more helpful is the fact that I'll pay the income tax on their portfolio, so it will grow tax-free, and my estate will go down. And then what's even more powerful is what I sell them for $5 million may be 99% of an LLC that has $7 million of assets, which we'll talk about in a couple of minutes. It'll just seem longer. So what can I do? I remember in 3rd grade, I didn't understand what she meant by preposition. What's a preposition? A preposition is anything a squirrel can do to a tree that's G-rated, because I was in 3rd grade. Now, what can a client do with a disregarded trust, a spousal limited access trust, or a trust for descendants or friends that is disregarded for income tax purposes? Well, one thing is you could loan money under 3 years at 4.83%, or you could loan money for more than 3 and up to 9 years, 4.25%, or you could loan money for more than 9 years, 4.4%. So per million, that would give you $44,000 a year. Or if you're 70 years old and of reasonable health, and maybe even not of reasonable health, you could do a 15-year self-canceling installment note at 9.256%, and on the death of the note holder, the note vanishes. It goes away like my watch, vanishes. So somebody who's not in great health may want to sell significant assets in exchange for a self-canceling installment note, and we'll talk about that as we proceed. Another thing this 70-year-old could do is she could sell $1 million worth of assets to a trust in exchange for the right to receive $105,949.04 a year for the rest of her life. And if she does this with $1 million and she dies in year 7, she's only gotten $700 back. Her estate is reduced by $300,000. And we're going to talk about the KITE case, K-I-T-E, and I forgot to have Brittany put the KITE video in our presentation, but if you search Gassman, KITE, K-I-T-E, annuity, you'll see a very serious instructional video with a a Broadway actress who sang a song that I wrote based upon the Beatles song, The Benefit of Mr. Kite, but it was Mrs. Kite. Another alternative is that this person could give $1 million worth of assets to a grantor retained annuity trust, as featured in the John Wayne movie True Grat. And in exchange for the $1 million of assets, receive back $372,000 a year for 3 years, and then whatever's left in the GRAT after the 3rd year is out of the estate for estate tax purposes. Now you might say, why would I do a GRAT as opposed to a sale? They look very similar. And the answer is that if you do a sale and the IRS says, hey, you undervalued the asset you sold, you may owe gift tax. With a GRAT, if the IRS comes in and challenges the value and you've acted in good faith, not blind faith, which is a great band, but good faith, which is not a great band, but a good standard, then on audit by the IRS, they can't impose a gift tax on you or take your gift tax exclusion down. Instead, they increase the payments that the GRAT would have paid. Now, there's disadvantages to a GRAT, besides the fact that that movie True Grat is pretty old now, but we can talk about GRATs later if you're interested. You're not interesting, but if you're interested, we can talk about GRATs later. And there's long-term GRATs, which can work very well, especially if you have a high earning business that's worth tens of millions of dollars that you want to get out of the client's estate. Okay, so now I'm going to look at see what the questions and answers are. Okay. Thanks from lawyers in Florida about the Chevron case. Is there continuing education credit for this program for Florida lawyers today? You're welcome on the Chevron case, but unfortunately, we did not register this in time for Florida lawyers to get continuing education credit. I'll be glad to give you a certificate of attendance, though, that you can put on your wall. Okay, Mike says, can you please elaborate in a SLAT, does it need to be funded by separate property of one spouse? Can community property be used? Excellent question. If your client is from California, Texas, Arizona, Wisconsin, Guam, France, or one of the other community property jurisdictions, you can put community property in the SLAT, but you need to have a consent and in many cases a transmutation out of community property status. And Brock Exline of my office and I put an article in the Stetson Law School Business Review recently on this, and if you want a copy of the article and you promise not to tell Stetson University that I sent it to you, then go ahead and send me an email or mark that in the question box, and we'll be sure to send that to you. Okay, here's a good question from Isaac, and that question is this, and this may sound like a crazy question, but why would I want my elderly, unpleasant mother-in-law to be a beneficiary of the SLAT? And the answer is because, first of all, it's the right thing to do. Secondly, her daughter or son is making you do it, so you better. And third, if you give that lovely person a power to direct trust assets to creditors of her estate, but only with the permission of your best friend from high school or your best friend from college, then, especially if they know each other, then on her death, you may have a new income tax basis equal to the fair market value of those assets on that sad day of her death. So I call that a third-party power of appointment step-up mechanism, which the acronym for that is VROOM. So you could ask your lawyer or accountant about that feature. Back to our exciting presentation. So now, by the way, is there too much humor or not enough? Oh, I love this by Gary. Let's go to the shameless self-promotion from an excited user of new EstateView who needs help getting going. All right, perfect. Thank you very much for being an EstateView user. Okay, installment sale to intentionally defective grantor trust. And by the way, I'll be working on EstateView probably at 11:50 to 11:55. So you can just completely ignore this until now. Put the music on. Anybody going to be in New York City July 18? I'm going to be there watching the Cream of Clapton band. Most people don't know that Eric Clapton's nephew, Will John, and Eric Clapton's drummer will be in New York City doing the 24 Nights album, which I'm really excited about. If you're going to that or you want to go, send me an email and we can have a drink in the lobby before a great show. All right. I think there's an NYU program the 18th and the 19th also that Jerry Hesh is going to be speaking at that might also be of interest. I don't think Eric Clapton knows about it yet, though. So here's John Smith. And John Smith has a revocable living trust. The Italian word for that is inter vivos, the Latin word. And John owns 1% voting and 99% non-voting. He owns the whole darn LLC. And the LLC has $10 million worth of adorable assets, a stock and bond portfolio that will grow on average at 7.2% a year, thus doubling every 10 years. Step 2, John, very much in love with John's spouse, forms the Smith Spousal Limited Access Trust. The spouse makes him do it. He gives that trust a $10,000 gift that goes into a Nevada bank account because it is a Nevada trust and they want Nevada law to apply. Their friend who lives in Nevada is a co-trustee. And then they open up a brokerage account and they put $700,000 of stocks and bonds into the brokerage account and they file a gift tax return and say, I just made a gift of $710,000. Now, maybe they let their children have $18,000 each withdrawal powers. They give the spouse a $5,000 withdrawal power that reduces the gift tax use. Maybe they put the mother-in-law or the father-in-law or both of them on as potential beneficiaries holding powers of attorney to get a step up on death. And then they do something very wizardy. John sells the 99% non-voting member interest. And sometimes on the chart, we put 99% NV, which then people think that's North Virginia, but it's non-voting. He sells the 99% non-voting member interest to the trustees in exchange for a interest-only promissory note, bearing interest at approximately 4.5%. And what's the purchase price? What would a willing buyer pay a willing seller for a non-voting member interest in a $10 million LLC? And the answer is somewhere between $6 million if you take a 40% discount and $8.5 million if you take a 15% discount, because the tax court cases have been all in that area. And Jerry Hesh says, get a less than 30% discount so you're less likely to be scrutinized by the IRS, because the discount is not the most important thing. But look what I've done here. I've done 4 great things. Five great things. Number 1, I've turned $10 million of assets into, let's say, a $7 million note. Number 2, I've taken 7.2% growth on 10 million assets, and I've made that 4.5% growth on a $7 million note. Third, I'm going to pay the income tax on the 10 million, dividends and interest and capital gains, thus reducing my estate. So I'll show you another way to do it. And if you're from Liverpool, you would set up, the client is Penny Lane. She sets up the Strawberry Fields S Corp. And it's a business, and it makes $2 million a year in dividends plus pays her a salary. So you go to the valuation expert. The valuation expert says, well, you know, venture capital may pay 7 times earnings with a non-compete, but there's no non-compete here. So we think it's worth 5 times earnings. So we think it's worth $10 million. And let's say it's minority owned. So Penny needs to keep 51% ownership. Well, Penny sets up the King's Trust. Maybe Penny's husband is the king. Maybe it's the King's Trust, and gives the King's Trust a $343,000 gift plus 1 bushel of strawberries, because I'm keeping with the Beatles theme here. That's what the strawberries are for. And then sells 49% of this $10 million company for a $3,430,000 note. That's about a 30% discount, 70% of 49%. And she's going to get $154,000 a year from that note. And now that trust is going to get almost $1 million a year. If the company's growing, it's going to get more than $1 million a year. So what does that look like? Well, the trust gets, if it reinvests the money at 7% rate of return, then it's going to have 11.4 million of investments plus 9.8 million of stock if you don't view the discount, minus a note of 3.4 million. It's going to have net equity of $18 million based upon $154,000. How much was the gift? Based upon a $343,000 gift. And Penny is going to get $1.20 million a year, but she's going to pay income tax of $800,000 in the state where she lives, and she's going to get her note payment. So we have tamed her estate. We don't sell it all to her, or her estate would dry up from the big burn. Plus, this way she keeps the minority status. 20 years later, the trust is worth $45 million. Estate tax savings, $18 million. The company sells for $30 million. This is the result. Penny ends up with $11.8 million. She's under the estate tax exemption. So that is the installment sale. And of course, the King's Trust empties out into separate GST exempt trusts for Rita Metermaid, Eleanor Rigby, and Lucy Diamond. So that is the story of the installment sale. Now, this is so effective, you would say, why would you do a GRAT when the installment sale is so effective? Well, first of all, a GRAT can be equally effective for estate tax planning purposes. And as I told you before, are you going to listen? The GRAT doesn't have the same gift tax situation. Like if Penny has already used her estate tax exemption and she makes this sale and the IRS says the stock is really worth $6 million, not $3.4 million, she would owe gift tax. But if this was a GRAT transaction, she would just get more in payments back. But the GRAT is not GST exempt, which means that when the GRAT eventually goes to the children, it has to be taxed in their estates if the children are subject to estate tax. But for a large estate, when you have a $500 or $600 million business, or a client who really doesn't want to pay gift tax, you could do a SLAT to the extent you can, and then different GRATs. So I give that to you as gratis information. Let me see what the questions are so far. Question, when's Brandon coming back? I don't know, you'll have to ask him. All right. And then the mute Ginger Baker is dead. Yes, the Cream of the band is a tribute band called the Cream of Clapton. The keyboard guy is the son of Clapton's bass player and is phenomenally talented. So you can just Google the Cream of Clapton Band and check them out. All right, the story of Maury and Leslie. I just ran some more numbers for you. They're 68 and 64 years old. They're going to live till 84. That's not 2084. That's till she's 84. And they have grandchildren. So without any planning, with a $6 million residence, $15 million of investments, no estate tax if they die this year, but they'd rather not die this year. If they die in 20 years, $9 million estate tax. If they fund a bypass trust on the first death, they'll have 13 million of estate tax. That helps a little bit. And that's what the estate tax looks like based upon the year they die. The red part is the part of the assets that go to the estate tax. But if they do an installment sale, there'll be no estate tax, but that slide is missing. So sorry about that. Brittany, let's send them the rest of the Maury and the Maury slides. We need more Maury slides because we forgot them. Another example of the installment sale is when both spouses have assets and you're concerned about the step transaction doctrine, spouse one, who may be the higher earner or less concerned about running out of assets, or perhaps shorter life expectancy, puts their share of the assets into an LLC. Spouse two puts their share of the assets into the LLC. They get back proportionate ownership. In this case, it was equal. And then spouse one sells to a SLAT. Spouse two sells to a descendants trust. Now, maybe these trusts are in Nevada and there's trust protectors who could add the people back to the trust as beneficiaries if they run out of assets and that's unexpected. That's some people call that the hybrid trust, although it has nothing to do with bread. And 10 years later, you have a tremendous result here. I mean, these people took 20 million worth of assets, turned them into $7 million notes, and then 10 years later, when 20 million grew to 40 million, after payment of the interest, these trusts have 10 or 11 million dollars each in them, having used very little gift tax. The gift tax, I mean, the gift exemption here used would have been about 7 million each. So then I have another example of another S Corp, but let's get down the road here. Speaking of the Wiz, which is also playing in New York City on Broadway, which I saw in 1976, and I'm looking forward to seeing it again. By the way, it hasn't been running since then. All right. So Brandon and I did a presentation in 2021 called the Biden third step, which followed another presentation called the Biden two-step. And it's no criticism of Joseph Biden. In fact, his tax lawyers were very appreciative of his aggressive effort to increase taxes. But in any event, what we talk about in the Biden third step article, and Brittany, we should send the Biden third step article to everybody but Stuart. Stuart asked a hard question, so he won't get this, but everyone else will. And that is, what do you do with a large promissory note besides cherish it forever? And fortunately, a lot of our clients have large promissory notes, and a lot of these are 1.9% notes. Well, now we can gift the note. We could, to use the client's estate tax exemption, we could put it into a Q-tip trust if the client is concerned about whether the exemption will come back up. We'll talk about that in a later talk. But one thing I tell the clients, we could put the note in an asset protection trust, or into an LLC, partly owned by the client, partly owned by a trust for the children, which may allow you to get a bigger discount for the note. Or I try to remember to tell my clients, congratulations on your large note. If and when you get a bad medical diagnosis, I want you to call your spouse first and me second, or vice versa, because there's something called a private annuity and there's something else called a self-canceling installment note, where we might be able to trade your note for a right to receive payments for the rest of your life. And of course, the client says, but I don't have a long life expectancy now. And I say, that is exactly the point. It's going to be very sad to lose you, but less sad than it would have been because of the estate tax savings. And if you think about this, I don't know what percentage of the US population of wealthy people understand and know when their life expectancy goes down significantly, but it's a lot of people. A lot of wealthy taxpayers will get the bad news, and I don't mean to joke about that, but when they get that bad news, they need to come to their estate tax planner and get some planning done. So converting that note to a private annuity, and as we're going to discuss, there's something called the exhaustion test, and I'm sure you understand it because you're exhausted from the time we've spent so far. The exhaustion test says that if I sell an asset to a trust in exchange for a private annuity, that trust has to be very, very well funded. In fact, this is a regulation that Chevron may overrule. I've got to look at that right after the presentation. See, if this regulation, which says that the trust has to have a net worth sufficient so that if it earns income at the 75/20 rate, which is 120% of the midterm applicable federal rate, which right now is about 5.2%, it would have to be sufficient so that if it earns income at 5.2% interest, it has enough money to pay the annuity until the person reaches 110. How many 110-year-olds have you ever met? The chances of getting to 110 right now, I think, are 1 in 100,000. So maybe that regulation's gone. But anyway, what Mrs. Kite did was she sold the assets to her children, which made Jerry Hesh say, wait a minute, if you sell the assets to your children, you'll incur an income tax on the payments. If you sell the assets to a grantor trust, you will not incur the income tax on the payments. But Mrs. Kite was obviously well informed, and they did an annuity that had no payments for the first 4 years, and she died before the 4th year. So I'm not sure what the income tax result was, but I'm guessing that they didn't pay any income tax. But because she did it directly with the children, now the children are going to have estate tax issues, which will make me happy if they come to see me. But in any event, the ability to, and I'm passing through some slides, the alternative is you convert the note to a self-canceling installment note. With a self-canceling installment note, and I'm going to show you the math in just a few minutes, with a self-canceling installment note, I may or I may not be able to use the actuarial tables that run parallel and actually are identical to the private annuity actuarial tables. The private annuity actuarial tables you can use because they're specifically condoned in the regulations. One nice thing about the revocation of the Chevron decision is that you can use the IRS's regulations against them, but they may not be able to use all of those regulations against you. So with a self-canceling installment note, Howard Zaritsky years back wrote that isn't a self-canceling installment note the same thing as a private annuity? It's a defined set of payments. So shouldn't I be able to use the Treasury Department regulations that apply to private annuities? Those regulations say that you can do the private annuity for somebody in poor health as long as there is no specific medical condition that is expected to cause the loss of life meaning death, within 1 year of death. So if I have a heart condition and there's a 49% chance that that'll bring me down within a year, I have COPD, there's a 49% chance that'll bring me down within a year. I have a cancer, there's a chance at a 49% chance that'll bring me down within a year. I could do a private annuity for a life payment where the first payment doesn't start for 3 years using those IRS tables, even though my life expectancy may be 15 weeks because I have all three of those things at the same time. On the other hand, with the self-canceling installment note, most of us thought you could use those same tables and not have the exhaustion test, but the IRS got a bit irate when Mr. Davidson, who owned the Detroit Pistons, sold some of the Pistons in exchange for self-canceling installment notes. And all kinds of heck broke loose when that happened. The IRS ended up settling the matter with the Davidson estate. And now, instead of self-canceling installment notes, we're inclined more often to do the private annuities. A couple of other things I'll say is that when you look at doing a self-canceling installment note or a private annuity, it doesn't have to be a single life instrument. So in other words, I've got Fred and Wilma Flintstone, and their estate planner, Barty Rubble, wants to do a self-canceling installment note for them. So we could do, if we did a 17-year self-canceling installment note, and it had to bear interest at 4.2% on Fred, or if we did one on Wilma, it would have to bear interest at 4.2%. And that's based on a 17-year life expectancy, which is the rule of thumb that most planners use. But you can go beyond life expectancy, but some people think you can't, so it's safer not to. But they could do a 21-year self-canceling installment note at 3.2%. This was back in January of 2021, where the applicable federal rate was very low. So if I'm going to do an installment sale, instead of doing one at 8 or 9% for my age, I'm 65, I could do a joint and survivor installment sale because there's no estate tax until Marcia and I have both passed. She's been 49 now for about 10 years. So that, when you run the numbers on a 65-year-old and a 49-year-old, the installment sale excess interest that you pay is much lower. And it works the same with a private annuity. So let me see if there was anything else I wanted to mention. Because I haven't spent 50 minutes yet, I'm going to tactfully do the shameless self-promotion. First, I'm going to see if there's any questions. Okay, the first question is, could you go another hour on the technicalities of these planning techniques? And the answer is no, sorry, I won't. Secondly, was the John Wayne movie True Grit or True Grit? Well, the John Wayne movie was True Grit, but back then you could do a grantor retained income trust where you wouldn't have to take a set payment every year. You could just take the income every year. You can still do those for nephews and nieces. Now, as I recall, in the movie True Grit, John Wayne did not have children, and therefore he could still do a grit today. So the movie still could be True Grit, but if John Wayne had children that he wanted to benefit, they would have been True Grat, which probably would have changed the theme a lot. Okay. Should we do the polling question, Brittany? Can we do the polling question? Okay. I'm trying to figure out how on earth to get people to buy EstateView. By the way, we do have some users. What can we get your thoughts on EstateView? A, by survey, B, by brief conversation, C, by conversational workshop, or D, give me a spinal tap. A third spinal tap. I guess you would need 2 to equal the difficulty in listening to this presentation so far. Are they filling that out, Brittany? Okay, we're done. All right. I didn't say we're dumb, Brittany. I said we're done. All right. So I'm going to go and open up EstateView. EstateView is a software program. I go to estateview.link, L-I-N-K, and if I've already signed up and paid for it, I use it. If I haven't signed up and paid for it, I can pay for it. That'd be a nice thing. Or you could get a free trial. Unlike most defendants who don't get a free trial, they just get a trial. You can also go to estateview.info, and I'll be showing you slides on all this. So let's go ahead and model out a private annuity. So I click on private annuity, and I go to standard mode, which is $195 a year. And for $195 a year, you can use all the calculators. It has all the calculators that our law firm has ever used from any software program, and it's called standard. It should be called like really better than standard, but we're not very good at marketing. We just call it standard. Of course, standard was good enough for John Rockefeller. That worked well for him. So right now, this tells me your 75/20 rate is 5.6%. And one life or two, I'm going to go with one life. And my client, let's say, is 65. Or if we go with the Beatles theme, we could stay with 64. And then it tells you use the nearest birthday. So this person may be 64, but if they're about to turn 65, then you put in 65 and you could put in the actual day. And then it says, do you want to have a deferral period? No, not necessarily. And do you want to have level payments or payments that go up? So we'll start with one life level with no deferral payment. And we'll start with a, let's say, a $5 million sale, having nothing to do with boats. So we click to see results. And what we have here is some warnings. You got to know about some things. And then our inputs went over to the left, over there. Across the top, I've got a 64-year-old, $5 million, level payment. The annual payment will be $453,000 a year. And the exhaustion test says that in order for me to do this sale, I have to have assets of $7,405,000 in the trust. That's a lot of assets. Now, some of you, many of us, have clients with large amounts of assets in these trusts. Needs to be a grant or trust for income tax purposes to not trigger income tax. But other clients don't have that much in assets in the trust. And by the way, I can click on the information thing and it tells me a little bit about it. I can close the information thing. So the alternative that should work is that they have wealthy children, and the wealthy children will guarantee the annuity to the extent of $7,405,035. But here's something the other calculators don't do, I don't think, and that is I click on duplicate over here on the left-hand side, and now it shows me annuity number 2. So annuity number 2, I'd like to know what do the payments need to be and what is the exhaustion test if I put this on 2 lives. So I click on 2, and then if Marcia has been 49 years old now for 10 or 12 years, I'll put 49. And now my payment only has to be $340,000 a year. I could darken that, isn't that cool? And my exhaustion test is $5,855,000. But wait, there's more. I can duplicate that. I can go to number 3, and I can say, let's wait 3 years to get our first payment. And then instead of level, let's start a graduated where the payments increase by 5% a year. And now you see that with graduated 5% a year, the annual annuity is $169 a year, even when it starts, but it's going to go up. So, and by the way, what do these annuities look like? I can click here and look at annuity number 1. This is what goes in the annuity. These are the annuity payments. This is the income on the annuity, just to get a picture of it. And then what are the chances of these of me and Marcia both being deceased at age 84 versus if it's both of us, one of us is more likely to make it to 96. You see, we have a 50% chance, just about, of me getting to 84, but together we have a 50% chance of one of us, and I know it's going to be her, making it for a longer period of time. And then if I do these 3 trusts, how much is each trust worth over time? So that's the standard mode, and about 5% of our subscribers take the standard mode, and I think the reason they do, it's only $195 a year, and it does what the other software programs do, and it allows you to do these side-by-side comparisons. Now I'll go, and I like to start at standard mode because it just kind of lets you get into it slowly. All right, so now I go to the Pro mode, which is $395 a year. And now what I can do with the Pro mode is I have a spreadsheet. So for each of these annuities, 1, 2, and 3, I have a spreadsheet that shows me the result for each year, and it even shows me the year of death and what happens after the year of death, because I'm interested in knowing what happens there. And if the spreadsheet doesn't quite fit, I can click on Fit With on the bottom right-hand side, and it'll fit nice. I can also get rid of some of the columns. Now, what we do here, which I think Kevin did a phenomenal job programming this. Kevin Gray is our full-time programmer. And on the left-hand side of the spreadsheet, you've got some data. And then the blue is what happens to the client, including how much income tax is the client paying on the burn, what's the cumulative reduction of her estate because she's paying income tax on the trust income, what is she receiving in payments every year, what is her annual spending adjusted for inflation, and then it keeps track of the trust and what's in the trust based upon her year of death. Now, if you want to see fewer columns because you find this to be disoriented, then you click Alter Detail Columns, and you could just have less columns. Click on Fewer Columns, whichever ones you want, and then now the spreadsheet has fewer columns. If you only want to see every other year, click on 2. If you want to see every 3rd year, click on 3. It'll always show you the year of death and the last year. So again, I'm designing this private annuity, and I can look at annuity 1. Here's what annuity 3 looks like for these folks. So the next thing I can do, and I can go to General Explanation, and I can click on 1, 2, or 3 of these annuities, and I can click on PowerPoint Presentation. Now we've just updated these, and I haven't tested it today. Kevin just added some features to this. So while it's creating the PowerPoints, I can take a break, but not a very long break, huh? So then I open up the PowerPoint, and there's the explanation of what we're doing with the numbers that we put in and the spreadsheet as well. So there's the age, I'm 64, probability of living to 85 is 53%. There's my inputs, there's my spreadsheet, and there's what that rascal looks like. When I die here, here's how much assets when I die are going to be in that trust. They're going to pass estate tax free, and that's what it's going to grow to for as long as I looked at it. And by the way, if I'm fortunate enough to die, if my children are fortunate enough for me to die earlier, there's what the estate tax savings looks like. So where did the software go? Did it run away? That's weird. Okay, I'll reopen it. EstateView.link. And there's the private annuity. Now, with the installment sale, and Jerry Hesch loves this calculator. We're going to call this the Heschelator. This is a simple spreadsheet that shows you on the left the client's assets growing and the burn, and shows you on the right the trust's assets, and in green there the estate tax savings based upon the year the client dies. So Jerry really likes this. It's a very simplified calculator. It does allow you to save the Excel spreadsheet, but Brandon and I typically will go to the self-canceling installment note calculator. So now let's talk about the SCIN. And I'm just at an hour here. I know it seems longer, but just to see how a SCIN works, I'll start a new application here. So the 75/20 rate, 5.6%, applicable federal rate, 4.4%. Now, you can use the lowest of April, May, June, and it automatically knows to use the 4.4%. I can look up the history of the applicable federal rates here. So now I have one life, and we'll go to age 64. I used to be 64. Now it's telling me life expectancy, according to the IRS tables, about 20 years. So it would be common to use a 19-year note, although you can go longer. And I understand that most of the other calculators will not allow you to go longer, but Jerry said make sure you can go longer with the promissory note. And you can go interest only or amortized. And let's go with a $10 million sale. So I click for results, and then across the top, you've got the age, you've got the amount, and then the interest rate is going to be your 4.4% applicable federal rate plus your 3.7% risk premium. You're going to have an 8% note. So it's good if you die early. It's not good if you don't die early. It will backfire. So that's note number one. I click on duplicate. And let's say again, Marcia and I want to do a note on joint and survivor. So move this down to, let's say she just turned 50 during this talk, just aged 1 year during the talk. So now the interest rate is much lower. The premium is 1.4%. The total interest rate is 5.88%. And sometimes we do an installment sale and the client says, well, this looks very effective, but I'd like to get bigger payments. Well, fine, we'll make part of the note self-canceling, and that'll get you the bigger payments. And if we're lucky enough to see you pass away soon, or unlucky, depending on how people look at it, then you will know the situation. So now I go to Pro Plus, and I'm able to see that the spreadsheet shows me what the savings will be each year based upon when the person dies from SLAT 1, I'm sorry, from SCIN 1 and from SCIN 2, and then I can do a third one. So I can click duplicate again, and this one I can go with a conventional note. So with a convention, well, let's see what it's like when you do a 30-year note. So with a 30-year note, now my interest rate is 6.33%, but if they both die within 30 years, I've got no estate tax. So that may be worth considering. But then I'll go to And by the way, it says, oops, you went past a boundary that you should reconsider. So anyway, now I'll do conventional. So I'll take out self-canceling. I'll do conventional. So this fifth note, there's a bigger estate tax savings by far if they live to the life expectancy, because they won't be getting such big payments. And then I could compare, I could explain the probability of death, and then I can compare what the results may be with each of these trusts based upon the year that they die. And then I can go to general explanation, which has nothing to do with the military. I can go ahead and do my PowerPoint. And I can also get a general explanation of the technique and a checklist. Click on that. And then there's my checklist. There's my general explanation of the technique. There's a private annuity PowerPoint. I'll go ahead and open that so that you can, again, see, you can show the client what you were doing there, what you put in the LLC, how much of a discount you took, et cetera, et cetera. And now if I want to share this with my client, we'll typically do a Zoom video, 5-10 minute Zoom video saying, here's what we've done. And then we can click share with client, generate URL. I can copy, and this is now copied to my browser. So now I just paste this into an email, tell the client, open it at 852-778, the secret password, and then they can use this software module all loaded up with this information for up to 14 days. So I can send it to the CPA, send it to the tax lawyer, send it to the financial planner, send it to the hairdresser, send it to the psychic, send it to the mother-in-law. Everyone can check it out. So that is, now we'll go to the SLAT calculator. Let me check for questions first. And by the way, the most of you are still on. I think a lot of you fell asleep and just forgot to turn it off, or your animals like to watch this show. I used to have a dog whistle, but my dog couldn't whistle after she drank beer, so we had to get rid of it. Okay. Can we look at changing assumptions, rates, and inflation? Yes, you can. That is built into most of our calculators, and then if it's not, you can export to a spreadsheet. But I think I'm gonna, Brittany, remind me to check with Kevin and make sure that we have you being able to set the inflation rate, I believe, on all of our calculators, or at least most of them. Okay, is there any documentation in or accompanying EstateView that describes the calculations? Okay, and Pamela, thank you for letting me know you're still here. I appreciate that. And James, thank you for agreeing not to tell anyone that I've sent you a copy of the Stetson article on community property. But again, I'm sorry, the question was, is there a general explanation? Well, there's an admiral explanation if you're in the Navy. For each of our calculators, for example, the Qualified Personal Residence Trust calculator, which I could talk about next week, when you go to Pro Plus, which is $495 a year, and you click on Generate Explanation, you do get a general explanation. You also get a short explanation, which is client specific, and you get the PowerPoint. So the only explanation we have for most of these calculators is the PowerPoint and the short explanation. So let me see, the short explanation is there. So the short explanation is not the best explanation, but it at least gives the planner, here are the numbers. Here's where we got it. But the amazing explanation, stupendous, colossal, Rolling Stone magazine rated this the best estate tax planning software in the history of rock and roll. And that is for single or married clients. So I'll do married just because it's a little bit even cooler than single. And in 3 minutes or less, you can show a client any one or more of these techniques in concert. See, rock and roll, in concert. So credit shelter trust, and by the way, I can make this bigger. So I can use a credit shelter trust, a CUPERT, annual gifting, discounted annual gifting, life insurance in and out of life insurance trusts, a large gift this year, an installment sale, and testamentary for charity. And I'll show all those to you. I can here put in my name, and I can put in my law firm's name, and then I can put in the client's name, and I can put in the date of birth of the client and or the age, depending on how I want to do it. Isn't that cool? When you move the age, it moves the date of birth. And then I can ask it, what's the life expectancy? And it will tell me based on smoker, non-smoker. And then I can tell it what year I want to see the client pass away. And then I can show the annual spending, which will be inflation adjusted. Until year 7, this person will save $250 a year from outside sources. And let's say after that, they'll retire and they'll start spending $250 a year from the portfolio. Then the wonderful other spouse and the age of the other spouse and the age of death and what the other spouse will spend after the death of the first dying spouse. Whether the estate tax exemption portability will be available to the surviving spouse. Whether the exemption will go down to half in 2026. There's where you put in your inflation rate. And chained inflation, which is what the exemption goes up by, is usually lower than real inflation. So chained inflation may be 3.46, real inflation may be 401. What the assets are worth that are investment assets. We only have 2 categories of assets, and that's residential assets and investment assets. We don't have anything fancier than that at this time. What's the growth rate? What are the annual costs involved? And what's the tax rate? So this person is paying 2% of the value of the $25 million portfolio every year. Now, something we have for you adept enthusiasts is an explosive asset module. I could turn it off or I could turn it on. And this is where the client, and we get a lot of this, the client says, I can value the company at $3.5 million, but if I get that patent, or I'm able to do this or that, I'm told that in 5 years, I'll be able to sell this company for $12 million and I'll pay $3 million of income tax on the sale. So should I consider putting that? What should I do with that? So you can, that goes in there. Then maybe they have 1 or 2 residences worth $3 million at a 3.75% rate of return. 1 or 2, you can do 1 or 2 CUPERTs. Now this is not as specific as our CUPERT calculator, but as you see, it tells me that if I do an 8-year CUPERT for a 73-year-old, my exemption on a $1.5 million house, half of a house, assuming a 15% discount, $611,000. That's mostly what you need to know. If I don't take a discount, if I take more than a 20% discount, it warns me. Don't do that. But if I take a no discount and just 1 CUPERT, then it tells me right there in the settings what's going on. And then bypass trust. Do I want to do one on the first death that benefits the surviving spouse without being subject to estate tax? How many children do I have now? And in 10 years, how many will I have? Life insurance situation. And then I'll come back to installment sale and charitable gifting. So it doesn't take long to put the information in. You could do this during a call with the client, or a paralegal can do it. We're coming up with an intake form, but I don't know that we really need it. So now your intakes are on your left still. If you want a shortcut, you want to go to bypass trust, click there on the top left and it takes you there. If I want to go to installment sale, it takes me there for the inputs. Okay, so now in the middle, this is the explanatory display. And on the right-hand side, I have these cute buttons, which allow me to show each scenario in succession. So I've turned on all of the alternatives. I don't have to show them all at once. I can show any one of them. But just to show you what it can do, if I want to show all of them, and typically we do for a large client, I click on dies in year one, no planning. And this client has a little bit of estate tax, $2.7 million, if they die at the end of this year. It even shows the growth during the year. But with planning, if they do what we're asking or what we're recommending, then there'll be no estate tax, but a charitable lead annuity trust will have received $750,000 to zero out the estate tax. The Cupert didn't help. The bypass trust didn't help much at all. The gifting trust helped a little bit. The installment sale actually helped. I mean, we went doing the installment sale just in year one, which we'll show you more detail later, took the estate tax from $2.7 million to only needing to give $750,000 to charity. We'll talk more about that. So, but then let's say that they have no planning and they live 20 years. And we know they're going to go longer than 20 years on average, but they may not even believe me if I show them the number beyond 20 years. At 20 years, their assets will have grown to $102 million. The estate tax will be $32 million. Pick them up off the floor. Yes, this is you. This is really you. And by the way, there's another way to look at it. There's a timeline. This is the year that the second spouse dies and how much tax there's going to be in each year. And there's a detail setting where you can see the details behind the calculations to some extent. So the client says, oh my gosh, what am I going to do? Well, the first thing you're going to do is you're going to leave a trust for the lifetime benefit of your spouse that's not going to be subject to estate tax. Oh, how does that work? Well, I click on bypass trust, there it is, and you can see the estate tax has gone down. Then what about that cute house trust, the Cupert? All right, I'll do a Cupert, click on Cupert. Now look at this, the house started at $3 million. By the time of the second death, it's worth $6.2 million out of the estate, plus cash from rent that was paid by the clients to use the house came to $1.1 million. So that was some estate tax savings. Then annual gifting, hooray, hooray. These little annual gifts, and by the way, when I click the button on the right, you'll see the input arise on the left. So I'll go back and I'll click bypass trust on the right, and there on the left you see I can monkey with this bypass trust. What if I don't want one? What if they can only put less in a bypass trust? When I move the numbers, everything changes. So then annual gifting. Well, that darn gift trust is going to have $4.4 million in it after 20 years. Then discounted gifting, if I take a 25% discount, it's going to have $5.8 million. Well, what if I take a 30% discount? Then it's going to have $6.2 million. Okay, what if I put the life insurance in a life insurance trust? So on the life insurance side, we give you the ability to put in a term policy or a permanent policy, and we give you the ability to have it in an ILET, in which case the premiums use up part of the gifting allowance, or outside of an ILET. And we're able to show you and you can also take a policy and say, well, right now it's a 600 policy. What if I make it a paid up 400 policy? And if you're not sure how much life insurance may cost for this couple, click on life insurance estimate, and then up comes life insurance estimate per million on a 64-year-old female, per million on a 73-year-old male, and at what term policies are usually available at standard and preferred, and also what a lifetime universal policy may cost. We don't sell life insurance, but I like to know for a client what it might cost in case they would ask me for that. Click on the red thing to have that go away. So now I click on life insurance. Now the life insurance is out of the estate. Okay, so then I go to a large gift. So right now I don't have a large gift, but let's say what would happen if these people would make a 10 million, if the husband would make a $10 million gift here of assets uh, worth 10 million into an LLC. We gift the 99% LLC interest, taking a 30% discount, and it's a grant or trust for income tax purposes. What's that going to save them? So I click on large gift, and that gift trust goes from 6 million to 40 million. That's pretty impressive, isn't it? That would be a reason to make a large gift. And then we have a calculator for this, but what if we just did, I'll just click, what if we do 1 more million? Watch that estate tax go from 15 million to 14 million 8. On, no, I'm sorry, it goes from, on a million, 10 million, the estate tax is 15 million 5, and at 11 million, the estate tax is 14 million 1. So you're getting more than what you gift out of the estate, and that gift trust goes up. But the client may not want to make such a large gift, or they may want to make a smaller gift, depending upon the psychology of it all. So the next thing I go to is the installment sale. So the installment sale, we'll look at the settings before we click. So these people would put 15 million of investments into, without the explosive asset, they'll leave out the explosive asset. They'll put 15 million of investments into an LLC, take a 30% discount, let's make it a 25%. And you see, this automatically tells me that the sale is for 10 million 5. And if I want to do a 10% seed capital gift, which is a rule of thumb in the industry, basically, I have a $1,050,000 gift. And what I'm doing here is a 4.4% note. You can say 4.5, and it's a conventional note, and it's a 20-year note. The note payment's going to be $472,000 a year, and it involves an S corp that's been giving the family $200,000 a year in income, which is now going to go into the installment sale trust. And I'm going to eliminate. Well, let's just see where it goes. So I click there, and now the estate tax is down to $1,297,000. So that almost eliminates the estate tax. In fact, I could just click up until the estate tax is gone. So I can just click up on the amount I put in, and it tells me there that to get the estate tax down to 0, I need to go to about 17 million into the LLC, which is pretty good. Now, what's interesting though is even when you get there and you say to the client, this may be enough, you've got to, try some other things. So this may be enough, but what if the growth rate on investments is 9%? Well, then it's still fine. Well, nope, at 8.23%, it's not quite enough. So maybe we need to do more. But what if I add in the explosive asset? If I put that in the installment sale, then that's, or I have an explosive asset and I consider the explosive asset. Now I need to put some of that explosive asset into the installment sale as well. If I put too much in, then the income tax may really be a problem on the sale. So all these things get entered into. You think about these things. People say, can I do an estate plan in 15 minutes? Yes. It just may not be the best estate plan if you're dealing with somebody complicated. So I can close that bar. But then I want to see, this looks like no estate tax, but really it is estate taxable because I'm only showing the end. Now, using the timeline, I'm seeing that there could be a big estate tax if they die during this period of time. So what I could do is make the installment note self-canceling during the first 2 years. And I could start it self-canceling during the first few years. And then when the red is gone, I could convert it back to non-self-canceling. So I think that's pretty interesting. Now I'll turn off the installment sale and show you remainder to charity. So there's two kinds of testamentary charities that we use. One is a charity, it goes outright to charity, and the other is a charitable lead annuity trust. So I click on testamentary charity. Let's go back to this. Now I'm looking at a $13 million estate tax. So I click on testamentary charity. So watch this. Instead of a 13 million estate tax and 73 million to the beneficiaries, now you see a 0 estate tax and 53 million to the beneficiaries and 33 million going to a foundation. Or if you want to do a charitable lead annuity trust, you've got 33 million going to the foundation, which pays 20 million to charity and then 13 million to beneficiaries. Now these numbers I input on the left, and it warns me that I need to have at least 50% go to charity to be realistic here. I can get these numbers from our charitable lead annuity trust calculator, but just to shorthand it, to show the client how this would work, I can go there. So I'll add back in the installment sale. Let me add back in the installment sale. And now you see you don't need charity if you're going to do the installment sale, but I want to also show off a little bit of charity. So how much can I back down the installment sale to? I can back the installment sale down to 9 million in the SLAT, and then charity gets a little bit. So I can show you how this works. So now we get to the magic part, and I click on generate client letter. I want to see all these scenarios. I'd like to see all different displays, and I'd like to write the client a letter. Now this used to take us a day and a half to write this letter. And when I was in law school, my final exam, it took me 2 hours to write an explanation for a similar plan. And I thank Douglas Miller for making us do it. And we did it all by hand with a calculator. There were no spreadsheets back then. So now, while I'm talking to the client or getting a cup of coffee or whatever else I'm doing, all those little squirrels in the computer are writing this letter, and it's a Word document, and I open it, and sure enough, I can enable editing, and there's my letter of what I'm doing here. So what I'm doing is showing them all my inputs and then explaining the estate tax system. And different planners, or alter the letter in different ways, and basically just showing and explaining each of these scenarios. So I can send the letter to the client. I can send a video from Zoom to the client. Our back room, also, just so you know, and by the way, I can also create PowerPoints, so I can just put all those slides into PowerPoints. And then our back room takes the transcript of me describing the plan and the PowerPoints and makes them into a document that is really cool. Brittany, you want to send one of those to everybody? So now I've got my PowerPoints. Now I can do my Zoom call or my Zoom recorded explanation. Then I can click share with client and send them the spreadsheet. So what does this end up doing? Well, number one, it educates our law firm on what the best plan is. Number two, it educates the client and the other advisors on how all this stuff works and how it can apply to the client. And number three, the client is much more likely, in our experience, to go forward. Now, just a couple of other things that it does, which I really like. The news feature, I can watch 4 different feeds at the same time, and I can choose what those feeds are. And I can also get summaries of them. So by the way, there's no artificial intelligence in our software. There's just lack of intelligence. We're not using artificial intelligence yet. This is from the news feeds. So that's one cool thing. And then I like the Monte Carlo calculator. It's oversimplified for a financial planner, but for my clients to play with, it's just right. Because it says if you have a 60-40 portfolio, 30 years, $1 million you're putting into it, then here is the upper 10 percentile. You're going to have 23 million bucks in 30 years. Here's the 50th percentile, 12 million 5. Here's the 10th bad percentile, 6 million 6. But then if I show the client, you know, you think that having more equities is riskier, but in actuality, and every time I click this, it's making, I think, 100,000 rolls of the dice. If I go to a 70-30 portfolio, then my 1 percentile, the worst 1% is 4.61, and the best 1% statistically is 14%. My average rate of return, 7.32 before expenses and taxes. Whereas if I'm 60-40, average rate of return 8.79. That's just based on the history of the market and conventional low cost allocation. I can also just figure out the life expectancy for the client and talk to them about life expectancy for 1 or 2 people. So now when a client walks in my door, they always have this display. So they understand there's a 50% chance that one of them will make it for 19.8 years, just so they know. And then there's a spreadsheet showing the probability of surviving any particular year. And there's a curve which shows that, you know, life expectancy is not a straight line. It's a curve. And once you've made it to 90, you got a much better chance of making it to 95 than when you were 70. So that's the life insurance calculator. And then another one we use that clients really like is the RMD calculator. So the client's coming in to see me. They've got 5 million in the IRA. They are going to live till 100. I like it when they live to 100. Then I can go to their 100th birthday party and have a nice meal. And they are now 69. So I click on results, and in the Pro edition of this, not Pro Plus, this is $399 a year. This shows them how much their plan is going to grow to and how much their withdrawals are and what's neat about it and how much the taxes on withdrawals. But what's neat about it is they never run out. At age 100, you still have 7 million. It doesn't even start coming down at this rate of return until you're 90 years old. And then the total taxes you're going to pay is 7 million too. So now I can go to Pro Plus, I can duplicate, and I can say, here's another idea. How would you like to give some money to charity? Well, how would that work? So I go down here. By the way, I could defer my first year RMD, my first year required minimum distribution. This shows me that it's going to be at age 73, but I can show that you could take generally twice as much the next year. And then maybe the person would like to give $25,000 a year inflation adjusted to charity from their minimum distribution. So now I'm showing the annual charitable donation, the distribution after charity, and I'm showing the tax savings from giving to charity. So a few clients have been able to make that charitable donation decision, and of course I could toggle it all the way up to 105,000 to charity. I could also allow the charity to start at age 70 and a half. You don't have to wait, and I can toggle up to the maximum 105,000. And you know, some clients have looked at that and said, okay, I want to do that. Let me call my church, call my museum, call my mosque, call my synagogue, And let's go ahead and get this done if this is a very efficient way to make gifts. So I've only scratched the surface here. Let me look for questions, and then I'll just take you through our shameless promotion PowerPoint deck, and then we're going to talk about timeshares. Let me see. Free lunch, timeshare, other questions. How does EstateView handle clients that have retirement accounts and conversions to Roth? We don't do Roth yet. I apologize. Does EstateView do state estate tax like New York and Massachusetts? Not yet. Hoping to have that well before the end of the year, at least for New York and Massachusetts. And so now let me see if I can find my deck. We'll deck the halls with tales of PowerPoints. Nope. Wrong deck. Wrong deck. That would be the Adirondack. Let me see where my deck went. There it is. It's a decadent. That's, Brittany, you want to remind me to have the puppet say that the PowerPoints are decadent next time? I'll do it, I'll do it. Okay. So for some reason, slideshow from the beginning, it's not listening to me. Okay, so EstateView software. Thanks to the 3 of you who are still here with me. Actually, there's a lot of you here still with me. So first of all, I thank Jerry Hash, Bob Keebler, and John Blotmacher for your confidence and all your fantastic ideas on EstateView. So if you go to estateview.info, you can enter through Interactive Legal, Weinberg Information Services, Ultimate Estate Planners, or Tom Dixon's Financial Experts Network. If you click on those and you're members of those, then you can get a little bit of a discount. If you click on Purchase EstateView, you'll warm my heart. And if you click on View EstateView Library, we have a library, which when you go to it, you click on any calculator, and Brandon or I think Joey, takes you through that calculator. So what a lot of people do is you open the software on your left computer, put the video on your right computer, turn on loud music, preferably the album 24 Nights by Eric Clapton. After the Journeyman album, he played 24 nights in a row at Royal Albert Hall. The first 4 nights were with a 4-person band. The next 15 nights, I think, or something like that, was with an 8-person band. And then the final nights were with, I believe, the London Symphony. So that album, 24 Nights, is a really good album. I think there's also a video. And again, I'll be in New York City July 18 with Eric Clapton's nephew. If you want to meet Eric Clapton's nephew, come along. I'm not kidding. Page 108. If you'd like to attend a free workshop where Joey, who's very talented, will take you through more detail than I just did, then that's fine. There's 5 of the upcoming dates. You can just let us know what date you prefer. If you're married, there's no dating, but your spouse can come to the workshop with you. It's free of charge. There's no obligation except to buy a timeshare. And then the ownership packages we have is $199. I thought it was $195. I guess the price just went up. But $199 for our standard package. And our standard package is everything the other calculators do, plus some other stuff. $499 is what 94% of the people are buying because it's everything. And then $24.99 gives you everything plus 4 hours of custom legal tax lawyer work and 30 hours of videos. So we would do the first ones, you would do the later ones, and then our back room would create these videos, which are pretty cool. Okay, so then, the pricing, are we doing a 10% discount right now, or how's that working?
If they buy it right
Okay, if you go there right now, and by the way, it's raining, so you better hurry in case the floods are coming. But if you go there, and you could bring the laptop, by the way, it works on an iPad. But if you go there right now, you can get a 10% discount. Is that open like an hour or so? Okay, 3 hours, and then we'll edit this out of the video so other people don't get confused. And then you've got here we show you the different stuff. So I think that's it. Let me just look for questions here. Besides, when is this darn thing going to be over? By the way, about 70% of you are still on, so I really appreciate that. I started this in 2011 with my son-in-law, David Archer. We drove down to Miami and we met with Jerry Hesh, who has always been my hero and a great mentor. And we finally went full-time in development about 1 year ago with Kevin Gray, and it's been fantastic. Oh, okay, can I buy 100 of them for my brokerage firm? And the answer is yes, we have volume discounts. I think I'll close here with the large gift calculator, because I think it's the one that, besides the married and single comprehensive, the large gift calculator is getting a lot of attention for good reason. And it's very much like the installment sale calculator that you saw, but I can put in specifics as to 3 tiers of income or spending. Like an executive may be 55 for 10 years, she's going to earn $600 a year. From 65 to 70, she may plan to earn $300 a year. From 70 on, she may plan to spend $400 a year. So I like to be able to put that. How much is the exemption? How much is the portability allowance? Are they married? Will there be a credit shelter trust? And how much do you want to gift? So it looks like the spreadsheet, which is fine. It shows you that you've got to gift a lot to use up to get to the core exemption. See that core exemption there? 5,000,008, and then the temporary exemption. So as I toggle up the gift amount, you see the core exemption is disappearing, but I'm not eating into that temporary exemption until I use the whole core exemption. And that's when the good stuff happens. You know, making a $7 million gift in 2025 isn't going to be nearly as good as a $10 million gift. And I can show that to the client up here as well, because up here it's showing me my incremental savings per million. So on a $7 million gift, my incremental savings per million is $861,000. But now I'll duplicate that. And on an $8 million gift, my incremental savings is $1,183,000. So that's the important of getting past half of the exemption. But then what Jerry says is, how much can you give? Well, I could give the whole $13,610,000. But what turned red? What turned red is when I got there, look, I end up running out of assets at age 100. So I can go to timeline and say, what the heck happened? How did this guy in gift number 3 or gift number 2 run out of assets at age 100? So I can illustrate to age 100. And I don't know about you, but I don't want to run out of assets at age 100. So, but there's the estate tax. So the more I gift or the less I gift, the less chance of me running out of assets, but the more chance of me paying a lot of estate tax. So what can I do? Well, I could discount the assets I give so I have more exemption. Does that help? Not really, not a lot. I can use crummy powers, that helps a tiny bit. But what I could do is toggle off grantor trust status. If I toggle off grantor trust status, so in other words, I stop paying the taxes for the trust in year 32, I toggle off grantor trust status, that gives me a situation where I'm not going to lose my assets, so maybe it's not so bad. Or I could plan to do a private annuity or a self-canceling installment note at a particular age. And then I can click on PowerPoint presentation, and then I've got an explanatory PowerPoint. By the end of the year, we'll have a letter for this, but it's a lot of work. Thank you, everybody. I welcome your questions, comments, and suggestions. If you had half as much fun doing this as I did, then I had twice as much fun as you. I stole that from Monty Python. They're my favorites. You're my second favorites. Have a fantastic rest of your day. Bye.